All right, folks, let's make sure we're streaming. Let's make sure everything's good. All right, so I have been a little absent on putting videos out the last few days. I did a short on the banks from last week on their earnings report and, what's really going on. Because the earnings report, what these look at is the previous 3 quarters. So what I'm looking for when I look at these earnings reports is I'm looking for what's coming down the road. So there were a few things going on here. I've got Goldman Sachs, I've got Johnson & Johnson, and I've got Citi, I think. Do I have Citi? I do. All right, Bank of America. So the first one I want to take a look at is Bank of America, right? So the earnings come out yesterday. Everybody's like, oh my God, look at their earnings. They're amazing. Revenues are down, but earnings are up, or it was revenues are up, earnings down. Anyway, whatever it was, I wasn't paying attention because this is what I was interested in. 5, right? So we have issues with inflation, people having to spend more on credit cards. Most people were living paycheck to paycheck anyway. This caught my eye. All right. In their earnings call, Bank of America said, hey, our 90 days past due is, it's still really low, still sitting on all-time lows. But you have to look at it in context. That's where it was. That's where it ended up after the last 90 days. But where is that 90 days delinquency rate possibly going? And this chart right here paints a picture. So 5 to 29 days late. Now, some of these are going to get cleared up, but some of these are going to end up in 30 to 59 days late, and then 60 to 89 days late. And then, look, let's be honest. Once something's 60 to 89 days late, it is more than likely going to end up on 90 days late. No question about it. Now, one of the things that they do on these charts to make it not look so great is they have different numbers for dollar amounts on the side. But let's look at what's transpired here. In 5 to 29 days since March, there has been a pretty decent increase in the amount of money that's 5 to 29 days late. Now, I need to give the investors department a call and see if they have the actual numbers, because I'm curious as to the actual account numbers. If you are a analyst or an advisor, there's different types of people who can call in and ask questions like that, and they'll give answers. If you're just a shareholder, they may not. It just kind of depends on the question you ask as to whether or not they're actually going to answer you, or if they're going to blow you off. And as you can see here in the 30 to 59 days, there is no give. It's a straight increase from June to September. And then 60 to 89 days late, another increase, and then we start to see 90 days late is starting to pick up. So these are credit card balances that are getting ready to go delinquent. This is what Bank of America is looking at 60 days from now. So really, for the most part, we're looking here and how this is going to move the 30 to 59 day into the 90 day. 5 to 29 days late may not mean much, because if you're 6 days late, you could be 6 days late because of just how you get paid. So that is not a good sign. That's showing a crack in the economy. That's something I'm looking at for potential revenue challenges later on down the road for companies. Then we're going to move to Goldman Sachs. Goldman Sachs is like, hey, our volume was carried by net interest income. Look, Bank of America's was too. Net interest income. Net interest income is interest on loans. So if these banks are being carried, especially Goldman Sachs, if they're being carried on net interest income and loans and not their advisory part of their business, that's a problem. And actually, if we look, most everything is pretty flat. Installment loans from Q3 last year to Q3 this year. But then you look at credit cards. We've gone from $6 billion in credit card loans to $14 billion in a year. $2 billion in a quarter. A $2 billion increase in card balances with Goldman Sachs. Now that's important because Goldman Sachs does not actually issue a lot of credit cards. Bank of America, JP Morgan, Capital One, those are your, Wells Fargo, those are your big credit card companies. Goldman Sachs is not. And to see a 133% increase in credit card balances from Q3 of last year to 3Q this year, that is not boding well. And allowance for loan losses down here, okay, $5 billion may not seem like a lot, but last year it was $3 billion. So you're looking at a 67% increase in loan losses from last year to this year. Folks, delinquencies are going to start going up. There's no doubt about it. The writing is on the wall that there are massive cracks in the foundation. Johnson & Johnson came in. Oh, and Goldman Sachs and Bank of America, both of them were like, they jumped up that same day because everybody looks at their earnings. But you really got to dive into the call itself and the books. You got to really pour over it because sometimes it's not always as rosy as they want you to believe it is. And sometimes it's also not as bad as how they're presenting it. It just kind of depends on what they're selling, how they're selling it for the earnings report. So Johnson & Johnson, pretty good. Earnings were up, all that good stuff. But this is what I look at, right? All right. Sales to customers. Year over year. But keep in mind, this is their third quarter. All right. So from 2021 to 2022. All right. So sorry, I was thinking that they had a fiscal quarter. 1.9% increase in sales. You're thinking that's not too, that's okay. They had an increase in sales. But look at their cost of products sold. 7% increase in cost of products sold. That is one of the biggest drivers for a company's bottom line outside of labor is cost of products sold. So cost of products, which actually labor is part of that number too, cost of products sold, because that's not really structured in here. Anyway, so 7.7% increase in cost of products sold. It's costing them more money to basically sell the same amount of goods year over year. So what are they going to do? They're going to have to start cutting costs so that they can make more money. They can see the writing on the wall, their gross profit, a slight decrease. They're going to have to do something. So they got to either lower the cost of their product or they're going to have to let people go to lower the cost of the product sold. They might even lower marketing. There's a lot of things that they can do to lower that cost, but one of them absolutely involves letting people go. So those are three companies that I wanted to look at where all three of them were like, yay, the media said, yay, great quarter. Good job, guys. Lots of cracks in the foundation when you really start digging into this stuff. And wish it was better news, folks, but it just simply isn't. So with that, I'm gonna leave y'all with that and let you talk amongst yourselves. If there's anything that you may have seen in these three reports that you want to discuss down in the comments, please feel free to do so. But again, I'm not looking back over the last 3 months as what they've done. I, as someone who is a fiduciary, licensed with FINRA, deals with customers, it is my job to prepare my clients for what's coming. So I have a much different focus on these books than most other people do. So anyway, with that, I'm going to go ahead and get off this, and hopefully I'll have a couple more videos. I know I haven't done anything in like 3 days, but hopefully we'll have something else out there tomorrow. So y'all have a good one. Enjoy things, and Frazzled Dad out.